New $6,000 senior tax deduction. What it means for you. All right now, this is the Wealthy Elder, and let's build wealth. Today, we're talking about the new $6,000 senior tax deduction that is now law. And while it sounds like great news for every retiree, the reality is a little different. Look, depending on your income, this could save you thousands of dollars, or it could mean absolutely nothing for you. I'm going to break down exactly what this new law means for you, whether you're in a low, middle, or high income bracket, so you know precisely where you stand. This isn't just another headline. This is a fundamental shift in how the tax code treats seniors, but only for a specific window of time and only for specific people. We're going to cut through the political noise and the confusing jargon to get to the bottom line. How much money stays in your pocket? Because what matters isn't the promise of a tax cut, but the actual tangible dollars you get to keep. So let's get into the details. Now, you've probably seen the headlines. Maybe you even got an email proclaiming that taxes on Social Security are a thing of the past. It's a powerful message, and it's a key feature of the massive new tax legislation. This bill makes sweeping changes, but the part that has everyone talking is the new temporary $6,000 bonus deduction for seniors. On the surface, it's simple. An extra $6,000 deduction for those age 65 and older. For a married couple where both of you are over 65, that's a potential $12,000 reduction in your taxable income. But this is the critical point that's getting lost. This is not a one-size-fits-all benefit. The real-world impact creates a stark divide among retirees. For some, it's a significant financial relief. For others, it's a political promise that provides zero actual benefit. Understanding which group you fall into is essential for your financial planning over the next 4 years. Section 1. The law explained. What exactly is this deduction? Before we can figure out what this means for you, we need to understand what it is. Let's break down the mechanics of this new law. First, and this is important, this is a tax deduction, not a tax credit. This is a crucial distinction. A tax credit is a dollar-for-dollar reduction of the taxes you owe. A tax deduction, on the other hand, just reduces your taxable income. The value of a deduction depends on your tax bracket. If you're in the 12% tax bracket, a $6,000 deduction saves you $720. If you're in the 22% tax bracket, that same deduction saves you $1,320. Now, here's the most critical part of this deduction. This new $6,000 bonus deduction is an addition to the standard deduction. You get this benefit only if you take the standard deduction, which nearly 90% of taxpayers do. If you are someone who itemizes your deductions, this new bonus deduction does not apply to you. This new $6,000 deduction stacks on top of the deductions seniors already receive. Let's visualize this like building blocks. For 2025, you have the base standard deduction. For a single filer, this is $15,750. On top of that, because you are over 65, you already get an additional standard deduction of $2,000. Now you get to add a third block, the new $6,000 bonus deduction. So let's add it all up for a single person over 65. $15,750 base standard deduction, $2,000 existing age-based deduction, plus $6,000 new bonus deduction. That brings your total deduction to $23,750. For a married couple where both spouses are 65 or older, it's even more. Their base standard deduction is $31,500. They each get the age-based extra deduction of $1,600 for a total of $3,200 for the couple. And now they each get the new $6,000 for a total of $12,000. Let's do the math for that couple. $31,500 base standard deduction, $3,200 existing age-based deductions, plus $12,000 new bonus deductions. Their total potential deduction is an incredible $46,700. This means the first $46,700 of their income is effectively tax-free at the federal level. However, there are two massive caveats. First, the deduction is temporary. It only applies to tax years 2025, 2026, 2027, and 2028. After that, it's gone. And second, and this is the most important part of our discussion today, this benefit is strictly limited by income.
Section 2. The impact on low-income seniors. A benefit in name only. All right, let's get to the first group, low-income seniors. The unfortunate reality of this new deduction is that for millions of you, it provides absolutely no financial benefit. It's a tax break that looks great on paper, but doesn't change your bottom line by a single cent. So why is that? The reason is simple. You can't get a refund for a tax you don't owe in the first place. Let's walk through a common scenario. Take a single retiree, Susan, age 70. Her only income is $24,000 a year from Social Security. Now, because of the complicated way Social Security is taxed, her provisional income is low enough that none of her benefits are subject to federal income tax. So Susan's adjusted gross income is zero. Before this new law, she already had the standard deduction of $15,750 and the extra age-based deduction of $2,000. That's a total of $17,750 in deductions. Since her taxable income was already zero, adding another $6,000 deduction on top does nothing. She owed no tax before, and she owes no tax now. This is the situation for a huge number of retirees. For these individuals, a bigger tax deduction is an empty gesture. They needed help in the form of direct payments or a refundable credit, something that puts money in their pocket regardless of tax liability. This deduction fails to do that. It's a tool designed for people who have a tax bill to reduce, and that simply doesn't include millions of seniors at the lowest end of the income spectrum. Section 3. The impact on middle-income seniors, the sweet spot. Okay, this is where the new law truly makes its mark. For middle-income seniors, this new $6,000 deduction is a significant financial win. These are the retirees who have income from pensions, IRAs, 401ks, or part-time work, and as a result, they have a federal tax liability. For them, this deduction directly translates into real savings. Let's take John and Mary, both 67, married and filing jointly. Their adjusted gross income for 2025 is $100,000 from a mix of sources. So this is what we have. Before the new deduction, their total deductions would have been $34,700, $31,500 standard plus $3,200 for age. Their taxable income would have been $100,000 minus $34,700, which is $65,300. Now let's calculate it with the new bonus deduction. Their new total deductions are $46,700, $34,700 plus $12,000 bonus. Their new taxable income is $100,000, AGI, minus $46,700, deductions, equals $53,300. The new law reduced their taxable income by a full $12,000. Assuming they're in the 12% marginal tax bracket, that translates into a direct tax saving of $1,440. For a couple on a fixed income, saving nearly $1,500 a year is a substantial relief. That's extra money for travel, for gifts for the grandkids, or just for peace of mind. This is the sweet spot. They make enough to owe federal income tax, but not so much that they get phased out of the new benefit. The White House has claimed this will result in nearly 90% of Social Security beneficiaries no longer paying federal income tax on their benefits. For couples like John and Mary, this massive new deduction can be large enough to completely shield all their taxable Social Security and then some. This is the core promise of the bill being delivered.
Section 4. The impact on upper-income seniors, the phase-out. Just as the deduction provides no benefit on the low end, it's also explicitly denied to those at the highest end. The law has strict income limitations, known as a phase-out. Here are the numbers you need to know. The phase-out starts for single filers with an AGI above $75,000 and for married couples with an AGI above $150,000. The deduction is completely gone for single filers with an AGI of $175,000 and for married couples with an AGI of $250,000. So how does this work? The deduction is reduced by 6% of whatever you earn above that initial threshold. Let's walk through it. Take a single filer, David, age 68, with an AGI of $100,000. This is $25,000 over the $75,000 threshold. The phase-out calculation, 6% of that $25,000 is $1,500. Reduced deduction. David's $6,000 bonus deduction is reduced by $1,500, so he only gets to claim a deduction of $4,500. Now a married couple, Robert and Linda, with an AGI of $200,000. They are $50,000 over their $150,000 threshold. The phase-out calculation, 6% of that $50,000 is $3,000. Reduced deduction. Their potential $12,000 bonus deduction is reduced by $3,000. They can only claim a deduction of $9,000. As you can see, the higher your income, the smaller the benefit until it disappears. This targeting means that seniors who may still consider themselves upper middle class, especially in high cost of living areas, will find themselves excluded. Navigating these constant changes in the tax code can be incredibly complex. What works for your neighbor might not work for you. If you want clear, actionable financial strategies in plain English, make sure you subscribe to this channel and click that notification bell. And I want to hear from you. Based on what we've discussed, do you think this new deduction will help you? Do you think it's fair? Let me know in the comments section below. I read every comment and your questions help me make future videos. Section 5. Actionable advice and strategy. So now you know the law and who it impacts. What can you do about it? For those of you on the edge of these income thresholds, a little planning can make a huge difference. Managing your AGI is the key. This is especially critical because the deduction is temporary, only lasting from 2025 through 2028. This creates a 4-year window where strategic income management is key. If your income is slightly above the phase-out, say $160,000 for a married couple, your goal should be to get your AGI below that $150,000 mark. How? One of the best tools for retirees over 70 and a half is the Qualified Charitable Distribution, or QCD. A QCD lets you donate up to $100,000 directly from your IRA to charity, and that amount is not included in your AGI. For someone on the cusp, a $10,000 QCD could lower their AGI enough to qualify for the full $12,000 bonus deduction. Another strategy is managing when you realize capital gains. If you're near a threshold, consider tax loss harvesting. This involves selling investments at a loss to cancel out your gains. You can even deduct up to $3,000 in net losses against your ordinary income each year. The key takeaway is this: the income thresholds are a planning opportunity. By proactively managing your AGI, you can put yourself in the best position to take full advantage of this temporary tax benefit. So let's bring it all together. The new $6,000 senior tax deduction is powerful but highly targeted. For low-income seniors living mostly on Social Security, this deduction is symbolic. It won't change your tax bill. For high-income seniors with incomes above $175,000 for singles or $250,000 for couples, this deduction is completely unavailable. The clear winners are middle-income seniors. If your household income is roughly between $40,000 and $150,000, you are in the sweet spot. This deduction will meaningfully reduce your taxable income over the next 4 years. This is a temporary measure, so planning is essential. Tax laws are never simple, but with the right information, you can navigate them to your advantage. Finally, a quick disclaimer. I am a lawyer, but I am not your lawyer. This video is for educational purposes only. The tax code is complex and your individual situation is unique. Please consult with a qualified professional to discuss your specific circumstances. Thank you for watching. We'll see you next time.